Friends, thank you for being here today. What if I told you that everything you think you know about the stock market is wrong? That the crash everyone fears isn't a bug, but a carefully planned feature of the system? What really defines our modern financial era is a central paradox, which is this great disconnect fueled by unprecedented and irrational overvaluation. We stand atop the longest and arguably most logic-defying bull market in history. By every traditional metric, every historical precedent, and every textbook definition of a bubble, the stock market should have already collapsed under the weight of its own absurdities. Yet it has not. Instead, it continues its relentless ascent, breaking records, shrugging off crises, and leaving generations of analysts and investors in a state of perpetual bewilderment. This profound disconnect between financial asset prices and the underlying economic reality is the single most important mystery of our time, and its answer reveals a truth far more disturbing than a simple market bubble. The market is not behaving this way by accident. It is behaving this way by design. The most sober and proven metrics for market valuation now flash warnings that are no longer just red, but a deep blinding crimson. Consider the Buffett indicator, the favorite valuation tool of Warren Buffett, one of history's most successful investors. The indicator is simple. It compares the total capitalization of all stocks in the market to the nation's gross domestic product, or GDP. It is a measure of the market's price versus the economy's actual output. Today, the total market capitalization stands at an estimated or 66 trillion. The United States GDP is approximately 30 trillion. This puts the Buffett indicator at a staggering 216%. To understand how insane this number is, one must look at history. Anything above 100% has historically signaled that the market is overvalued and that a correction is likely. Just before the dot bubble burst in the year 2000, a crash that vaporized portfolios and led to a brutal recession, the indicator peaked at 115%. Today, our valuation is not 115%. It is not 150%. It is 216%. We are, by this reliable measure, nearly twice as overvalued as we were at the apex of one of the greatest speculative manas ever recorded. By this metric alone, the market should not just be corrected. It should be in ruins. This irrationality drills down to the very core of the market's biggest companies. If one looks at the price to earnings, or P, divided by E ratios of the top companies in the S&P 500, the market's drivers, the engines of its growth, the situation becomes even more shocking. The average P divided by E ratio for these dominant firms hovers around 66. This figure is by any historical standard absurd. A normal healthy P divided by E ratio for a stable company is typically between 15 and 20. A high-growth technology company pricing in future innovation might trade at 25 or perhaps even 30, but 66 is in a different universe of logic. It means that investors are willing to pay or 66 today for every $1 that a company earns in profit. It is the financial equivalent of paying 66 for a one-nutted hamburger. It makes no sense, and yet people keep buying. The final deafening alarm bell comes from the smart money itself. When the most successful and disciplined value investors on the planet refuse to participate, it is a signal of existential danger. Warren Buffett, the man who built a dynasty by buying quality assets at fair prices, is not buying. Instead, he is sitting on record-breaking levels of cash. This is not a vote of confidence. It is the ultimate signal that assets are so dangerously overpriced that the world's greatest investor would rather hold depreciating cash an asset he famously despises, than risk it in a market he knows is fundamentally broken. When the professional arsonists are all standing outside the building, you know the fire is not far off. This confluence of unprecedented valuation, nonsensical earnings multiples, and the retreat of smart money creates an unanswerable case for a crash. The fact that it has not arrived proves that we are no longer operating in the system we thought we were. This is because the very design of the system has been changed. It's no longer a free market. It's a controlled mechanism. And the cognitive dissonance felt by so many investors stems from not understanding this new design, from still believing in the traditional market cycle. For generations, this cycle was as predictable as the seasons. It began with excitement and optimism as money flowed in and prices rose. This optimism would curdle into greed and euphoria at the peak, a point where valuations became detached from reality. At this peak, the smart money, the large institutions, and disciplined investors would quietly begin to sell their holdings to the ecstatic public. There, the system is broken. How the free market became a controlled demolition. Selling would eventually trigger panic, which would cascade into a full-blown crash. The market would find a bottom, the slate would be wiped clean, and a new healthy cycle would begin. This pattern has repeated again and again, but now that pattern is broken. We are demonstrably at a peak of historic proportions, yet the major players are not dumping their assets en masse. The smart money is not in aggregate running for the exits. This deviation tells us something profound. The game has changed. The system itself is no longer the free market we read about in textbooks. It is not a natural ecosystem of price discovery. Instead, it has been transformed into a controlled demolition, a managed mechanism where the timing of booms and busts is no longer an economic event but a strategic one. The market no longer crashes when gravity dictates. It crashes when the puppet masters, an orchestrated cabal of central banks and financial institutions, decide to cut the strings. This new system is at its core a two-tiered one. There is the public market, the one broadcast on financial news, the one where retail investors are encouraged to buy and hold for their retirement, participating in their 401k programs. This market is built on an illusion of fair participation and equal opportunity. It is a facade. Then there is the real market, a private opaque system that operates behind the curtains. This second system, governed by different rules and accessible only to a select few, is not a mechanism for investment, but a mechanism for extraction. It is designed to methodically and systematically siphon wealth from the public participants and concentrate it into the hands of its operators. The reason the market has not crashed is that this extraction mechanism is still running at full capacity, and its controllers have deemed it not yet strategically advantageous to initiate the next collapse. So to understand how this artificial system is sustained against the forces of economic gravity, you have to identify its fuel sources, the hidden engines, if you will, that are keeping it artificially afloat. These are not the traditional engines of productivity, innovation, or corporate efficiency. They are massive hidden inputs of artificial stimulus and currency debasement. The first and most powerful engine is massive government spending and its associated deficits. The United States government is by an enormous margin the single largest spender in the economy. Every year it collects approximately $5 trillion in taxes, But it does not just spend that $5 trillion. It also spends an additional $2 trillion at minimum, which it borrows into existence. This combined $7 trillion is not sequestered in a vault. It is injected directly into the veins of the economy. It pays for Social Security, for Medicare, for military contracts, and for interest on the national debt. This money then flows through the system. The recipients of these payments, citizens, contractors, and bond holders, do not hoard it. They spend it. They buy iPhones. They purchase cars. They fill their gas tanks. They eat at restaurants. And where does all of that money invariably end up? It flows directly into the cash registers and quarterly earnings reports of the very same corporations that dominate the S&P 500. The government, through its unprecedented deficit spending, is providing a colossal non-stop multi-trillion-dollar subsidy to corporate profits. This fire hose of borrowed cash artificially inflates corporate earnings, which in turn props up their stock prices, holding the entire edifice aloft. The second engine is the geopolitical imperative behind this spending. This reckless deficit spending is not merely a matter of poor domestic policy. It is a conscious strategic, the hidden fuel, how deficit spending and inflation artificially prop up stocks choice. The global order established in 1945, one controlled and dominated by the United States, is now under serious threat. Rising nations, China, India, Russia, and the BRICS bloc are actively building parallel systems. They are creating their own financial networks, their own trade agreements, and their own military alliances. They no longer wish to be dependent on the US dollar or the US system. This challenge threatens America's global dominance. In response, the US has made a strategic choice: spend whatever it takes, borrow whatever is necessary, and print whatever is required to maintain its supremacy. The priority is to protect its global dominance, and the massive deficits are seen as a necessary cost of this new great power conflict. The stock market is in this sense a secondary beneficiary, a side effect of a much larger strategic war. The third and most insidious engine is the devaluation bet. When a government borrows and prints $2 trillion more than it takes in every single year, the inevitable consequence is that the value of every existing dollar decreases. This is not complicated. It is simple supply and demand. This is inflation. This is currency devaluation. The smart money still in the market understands this perfectly. They are not buying stocks at a P divided by E of 66 because they believe in a productivity miracle. They are buying stocks as a desperate hedge against the deliberate and ongoing debasement of the US dollar. They are fleeing the currency. Stocks, real estate, and other hard assets are simply lifeboats in a currency flood. This dynamic provides the final twisted justification for today's insane valuations. How can a company with a P divided by E of 66 be a good buy? Because if the dollar's value is cut in half by inflation, that company can simply double the price of its product. Its nominal profit will double from 1 to 2, even if it produces nothing new. Suddenly, its P divided by E ratio looks much more reasonable. The entire stock market's rise is not a bet on American growth. It is a quiet, ongoing bet on American inflation and the devaluation of its currency. Now, while these hidden engines provide the fuel, that's only part of the story. You also have to look at the rigged game, the specific mechanisms used to actively control the system and direct that flow of wealth. While these hidden engines provide the fuel, A set of actively rigged mechanisms and controlled interventions are required to manage the system and direct the flow of wealth. The first mechanism is quantitative easing or QE to the public. This was sold as a complex but necessary tool to stimulate the economy and help Main Street during a crisis. The reality is that it is one of the most elegant and ruthless wealth transfer systems ever created. The newly created money never reaches Main Street. It flows directly from the Federal Reserve's computers into the financial markets, where it is used to buy bonds and other assets. This massive purchasing pressure inflates the price of all assets, stocks, bonds, and real estate. And who owns the vast majority of these assets? The top 5% of the population. QE is in effect printing money for people who already have money. The mechanics of QE reveal its true nature as an insider trading loop. The Federal Reserve pre-announces its bond buying programs detailing what it will buy, when, and in what quantity. This advanced notice allows primary dealer banks to frontier run the Fed. They use their own funds to purchase these exact same bonds at current market prices moments before the Fed's massive price-moving purchase begins. Then, when the Fed enters the market as promised, demand spikes, prices rise, and the banks sell their holdings back to the Federal Reserve at an inflated price for an immediate guaranteed risk-free profit. If any private company coordinated this way, it would be a felony. When the government and its partnered banks do it, it is simply called bold monetary policy. The second mechanism is the use of controlled crashes as pressure release valves. When the inequality and speculation become too obvious, the systems managers initiate these controlled demolitions. Their purpose is threefold: to wipe out the weak hands, leveraged retail speculators, to eliminate smaller competition, and to allow the core players to consolidate even more power at bargain prices. This script is repeated in every crisis. First, insiders take excessive risks and market those risks to the unsuspecting. The rigged game, QE, insider trading loops, and dark pools, the end game. The crash will be strategic, not economic public. Second, a controlled demolition is triggered when the scheme reaches its limit. Third, the connected players who created the crisis receive massive bailouts. Finally, these bailed out players consolidate their power, buying up the assets of their failed competitors for pennies on the dollar. We saw this in the year 2000 with the dot-com crash, where insiders and venture capitalists cashed out at peak valuations, leaving retail investors to hold worthless shares in companies that existed only on paper. We saw it in 2008 with the global financial crisis, where banks packaged toxic mortgage assets, sold them to pension funds, bet against their own products, and then received taxpayer bailouts, becoming too big to fail, while millions of homeowners lost everything. And we saw it most clearly in 2020. The pandemic provided the perfect cover for the largest wealth transfer in modern history. Small businesses, non-essential, were forcibly closed by government mandate, while mega corporations, essential, were not only allowed to operate, but were funneled trillions of dollars in stimulus. The market crashed just long enough to shake out the weak hands, only to rocket to new highs fueled by unprecedented money printing, allowing the wealthy to buy the dip at a fire sale. The third mechanism is the very plumbing of the market itself. The market is a two-tiered infrastructure. On one level, you have high-frequency trading, or HFT. Sophisticated algorithms execute thousands of trades per second, not to invest in companies, but to skim microscopic profits from every transaction. They fronter run public orders, detecting a buy order and purchasing the stock a millisecond before only to sell it back to the original buyer at a fraction of a cent higher, multiplied by billions of trades. This is a multi-billion-dollar siphon extracting wealth from every pension fund, mutual fund, and individual investor. On a deeper level, you have dark pools. These are not a metaphor. They are literal private stock exchanges for large institutions. There are over 50 of these private exchanges operating in the United States, processing nearly half of all equity trades. In these dark pools, institutions can trade massive volumes of stock completely in secret away from public scrutiny. This allows them to coordinate strategies and manipulate prices in ways that would be impossible on a transparent public exchange. The market you see on television is the show. The real game happens in the dark. The final mechanism is coordinated systemic intervention. The Federal Reserve, the Treasury Department, major banks and regulatory agencies do not act as independent checks on one another. They function as a coordinated orchestra. The collapse of Silicon Valley Bank in March of 2023 was a perfect example. The law was clear. The FDIC insures deposits up to $250,000. But SVB's clients were not average citizens. They were venture capital firms and tech startups with tens of millions of dollars in their accounts. In a matter of hours, regulators tore up the law and announced that all deposits would be guaranteed, even those far above the legal limit. This was not about protecting depositors. It was about protecting the system and its most connected players. This intervention extends to suspending reality itself. Right now, banks are sitting on hundreds of billions of dollars in unrealized losses from long-term government bonds they purchased when interest rates were near zero. Now that rates are high, the market value of those bonds has plummeted by any honest accounting standard. These losses would render many institutions technically insolvent. Yet the system has collectively agreed to ignore this. Regulators allow banks to paper over these losses, pretending they don't exist. The normal rules of mathematics and economics have been officially suspended for players important enough to matter. And the consequences of this artificial system, this actively manipulated, sustained system, they aren't theoretical. They are a devastating reality for the majority of the population. The most visible outcome is a chasm of wealth inequality that is tearing the social fabric apart. This system has been architected to create this exact outcome. The asset divide is a direct result of policy. The top 10% of Americans own the vast majority of financial assets. When the Federal Reserve prints trillions of dollars to inflate the price of those assets, it is a direct tax-free wealth injection for the richest echelon of society. Meanwhile, the bottom 90% of the population who own almost no significant assets experience this same policy not as a benefit, but as a crushing cost. For them, the money printing does not show up in their brokerage account. It shows up at the grocery store, in their rent check, and at the gas pump. Their wages, which are stagnant, cannot keep pace with the rising costs of basic necessities. This is the squeeze on Main Street. The very same policy that creates record wealth for the few simultaneously creates inescapable financial pressure for the many. The wealth gap is not a bug in the system. It is its primary feature. This dynamic creates what can only be called a participation trap for anyone working within the financial industry. The professionals managing institutional money, the pension fund administrators, the insurance company managers understand this disconnect. They know the system is unsustainable, propped up by intervention, and destined for a fall. But they are powerless to act on this knowledge. They are trapped by their own benchmarks. Consider a pension fund manager who believes the market is a house of cards. If he acts responsibly and moves his fund's assets to cash, he immediately faces a career-ending risk. As the manipulated S&P 500 continues to climb, his fund will drastically underperform its benchmark. His investors will pull their money and his board will fire him for incompetence long before the crash ever vindicates him. To survive, to keep his job, he must remain complicit. He must continue to buy the same overpriced, manipulated assets that he knows will one day collapse. Everyone inside the system is forced to support it, even as they know it is a lie, hoping only to extract enough personal wealth to survive the inevitable reckoning. This participation trap, however, is not confined to the trading floors of Wall Street. It is a cultural and intellectual trap that extends into the very institutions meant to be our watchdogs, the media, academia, and politics. This is the narrative shield that protects the machine. The financial media, for its part, plays the role of a carnival barker, not an investigative journalist. It normalizes the absurd. It reports on the daily meaningless fluctuations of the Dow Jones as if they are natural phenomena, like the weather rather than the engineered outcomes of policy decisions. It breathlessly discusses Fed watching, debating whether the central bank will raise or lower rates by a quarter point. But it never ever questions the legitimacy of a small, unelected committee having the power to print trillions of dollars and centrally plan the cost of money in the first place. This creates a fog of complexity, a barrier of jargon designed to make the average person feel too unsophisticated to question the system's core tenets. Simultaneously, the media machine masterfully frames all economic discontent through a divisive political lens. It is never the public versus the banks. It is left versus right. The public is encouraged to fight over symptoms, whether government spending is too high or corporate taxes are too low. This is a manufactured diversion. It keeps the population distracted and fighting amongst itself, ensuring no one ever looks up to see that both political parties are captured, both ultimately serving the same financial masters who fund them and both fully committed to the core mechanisms of bailouts and currency creation that enable the entire extraction. Academia provides the intellectual justification for this framework. Our most prestigious universities produce complex economic models that by their very design assume the system is rational and efficient. These models are built on equations that exclude the very concepts of power, insider manipulation, or coordinated control. An economist who builds a theory based on the reality of a controlled demolition is not a candidate for a Nobel Prize. They are dismissed as a crank or a conspiracy theorist. To succeed in the field, to gain tenure and prestigious appointments, one must operate within the accepted sanitized boundaries. This creates an intellectual feedback loop, a hermetic seal where the experts advising the government and the central banks are the very people whose careers depend on not seeing the system for what it is. This triumvirate of media distraction, academic justification, and political theater creates an almost impenetrable narrative shield. It ensures that the public is too confused, too divided, or too intimidated by expert opinion to challenge the fundamental premise of the system. The public is busy arguing about pronouns and partisan talking points, while the real war, a silent financial war, is being waged against them. And the wealth of a nation is being siphoned upward by the very institutions that claim to be its guardians. This brings us to the inevitable endgame, and it explains why the final crash will be strategic, not economic. This entire construct explains why for years every crash prediction has failed. The analysts making these predictions have been using the wrong tools. They assume the market operates according to traditional economic principles. They calculate debt to GDP ratios, P divided by E multiples, and historical volatility patterns as if these metrics still determine outcomes. But in a system where policy trumps mathematics, these calculations are useless academic exercises. The metrics are obsolete because the market itself is now self-referential. Asset prices no longer reflect underlying economic reality. They reflect policy intentions. The market has become a machine for discounting the future actions of the Federal Reserve. The only question that matters is not are corporate profits real, but will the Fed pivot and print more money? As long as the intervention machinery keeps functioning, the fundamentals do not matter. This, however, cannot last forever. The distortions are building up like pressure in a sealed system. The system is mathematically, socially, and politically unsustainable. The endgame will not be triggered by a bad earnings report or a rise in unemployment. It will be triggered by a failure of the intervention apparatus itself. The real triggers will be a loss of faith. This collapse could be initiated when foreign creditors, no longer willing to trade real goods for digitally printed currency, begin to demand real assets in payment. It could be triggered by social unrest at home when the bottom 90% squeezed beyond their breaking point by inflation reach a level of desperation that threatens the political stability required for this wealth extraction to continue. Or it could be triggered by a generational rejection when younger generations buried under mathematically impossible debt obligations created to enrich a shrinking elite simply refuse to honor those debts. So, when will the stock market finally crash? The answer is simple, and it is the key to the entire thesis. The crash will not come when the market is broken. The crash will come when breaking the market becomes more profitable and strategically advantageous for its controllers than sustaining it. The timing will not be economic. It will be strategic. The system will be allowed to collapse only when those in control have fully positioned themselves to benefit from it. When that day arrives, it will be presented as another unforeseeable crisis. And just like every collapse before it, the connected will prosper from the chaos while everyone else pays the